For sticking with us and to all of our folks online. My name is Jason Gross. My day job is Vice President and Head of Platform for Manchester Story. We are an early stage venture capital firm that is backed by 24 insurance carriers, brokers, and wholesalers. And we use that capital to invest in early stage insurtech and fintech companies. But prior to that, I spent 20 years on the insurance carrier space, largely in IT transformation, corporate strategy, and innovation. And because of that, it's my real sincere pleasure to be up here with Jeff Mango, Managing Director of AM Best. And Jeff, before I turn it over to you to do some introductions and tell us a little bit more about AM Best, we may have some students who have heard of AM Best but maybe don't know as much about what you do and how you do it. It's also a real pleasure to have AM Best so active in the industry. I was recalling back, it was just last year at the Global Insurance Symposium here in Des Moines that your CEO, Matt Mosher, and Andrea Keenan were on stage. I got to see Andrea earlier this week over in Omaha at the InsurTech on the Silicon Prairie event. So your engagement across the industry, I think, is really impressive, beyond just being a credit rating agency. So Jeff, maybe give us a little bit about your background and tell us a little bit about AM Best.
That's good. Thank you. I appreciate it, Jason. Yeah, I've been at AM Best probably just about 19 years. Ran a team of analysts, so credit rating analysts, actively involved on the property and casualty side for about 10 years. The director, I had a team of analysts doing that. Moved into operations, so I got to see global operations and how we did things, heavily involved with regulators at that point, trying to put together processes and procedures and working with our risk management team particularly. And as of late, as you mentioned Andrea's name, that's where, right prior to that, I worked for Matt directly and now report to Andrea on what we call the Strategy and Communications Group. I'm a CPA by trade, so doing industry research, industry relations, which is interacting with 100+ organizations around the world, and public relations is something different for a bean counter, but I'm enjoying it, and it's pretty well-rounded experience seeing it. So AM Best, and again, to touch on what we do, we only do insurance. We do credit ratings, so when you think of the others, some of the names that came up in the past day or so, S&P, Moody's, they have all lines of business, all industries, and all we focus on and have since 1899 is just credit ratings for the insurance industry. So as Matt Mosher would always say, that's all we do. We better do it damn well. We better be the best at it, and we think we are with some of the processes and criteria we have in place.
Well,
So.
and you do it well. And Jeff, I also know that you have also evolved over time, and how you look at creating credit ratings for the insurance industry has evolved. And I was actually just reflecting back this morning that it was 10 years ago that AM Best introduced the enterprise risk management criteria to start to score insurance companies on that aspect.
Yeah, absolutely. And that's really one of the four primary focuses of the credit rating process: balance sheet strength, operating performance, evaluating the enterprise risk management, and then the last one is business profile, which is a lot more subjective, certainly when you're talking capital models and reinsurance programs and fungibility capital amongst the organization at the balance sheet strength section. The much easier to assess, but we did come out with the enterprise risk management because we saw that was such a primary focus. Obviously, that's all you do. You're risk managers day to day. So we ended up carving that out as a separate item. We had focused on it across the board prior to that, but we felt it was necessary to be more transparent to the market and explain to the market what our analysis were for these companies.
Well, so if that was 10 years ago, we're going to fast forward now to 2019.
Yep.
AM Best came out with a set of criteria for scoring and assessing innovation in insurance companies. And of course, that's the title of our conversation this morning, is Insurance Innovation Criteria and Impact. So before we get into the mechanism for scoring and assessing innovation, maybe share the why or the backstory. What led AM Best to say this is something that we should also develop a criteria around?
Yeah, I think it's similar to enterprise risk management in the perspective of again, it was always part of our analytical process when we're rating companies to look at innovation, to see what they're doing, not only from a product and a client-facing perspective, but also from an internal process perspective. How are they innovating? And with the pace and the magnitude of technological changes and also societal changes and societal behavior changes on how clients and customers are purchasing insurance, we felt it necessary to be a little more transparent with that and to codify it, so to speak, with the criteria that we did come out with on how we look at innovation. So it's a criteria that did come out in 2019 for comment. And I can tell you there was a lot of back and forth with constituents across the board, brokers, carriers, consultants, getting feedback from them. And it usually doesn't take this long to finalize a criteria, but it was March 5th of 2020 when we actually finalized it and came out with it. I guess a bit fortuitous because a week and a half later things shut down. Everybody just had innovation on board. What are we doing? So we didn't certainly plan that, obviously, but it's really from our perspective and for what we're in the market, it's critical to the financial success. And I'll just give you a little, before we get into the what and the nuts and bolts of it. We rate over 3,600 companies globally in 100 plus countries. So this population of 3,600 companies, we asked them through different survey mechanisms, how critical is innovation to your organization? So you come up with top 5, and it was this output is just one portion of that, but I think it paints a picture. So extremely critical, 15%. Very critical, 45%. Moderately critical, 30%. So the top 2 tiers, 60% in total, 90%. So they all feel it's absolutely important, right? And we do too. So I think that'll just keep those figures in mind as I step through what feedback and what analytical process we've gone through since 2020. So.
Well, I remember very well, even sitting down with some of the AM Best folks at InsurTech Connect, back in 2019 after it was released and in the comment period. And I remember there was a lot of contention. Some folks were really behind it. I thought it was, you guys really hit the nail on the head, and we'll talk about the mechanism here in a minute. But a lot of others were still like, sitting on the sidelines around innovation. But I think your point that the COVID, the pandemic, really changed everything for a lot of carriers, and they were scrambling. And those who were already being more innovative probably had an easier transition to sending their folks home and working remotely and still taking care of their distribution partners and customers.
Yeah, and anytime we come out with something different, how we're going to look at or update our criteria, there's certainly pushback. Some embrace it, some push back, but I think that's just the nature of trying to be transparent with the market. We place an A- or an A or a B+ on a company. We want to let the market know why, and this innovation in the ERM is just a natural progression of that.
Well, that was a real life example. So I remember I was at a carrier, and we had gone through this workplace of the future exercise. And in the 6 months, fall of 2019, early 2020, we took like our last 600 people off of desktops and put them onto laptops, and we rolled out, Teams and Zoom and collaboration tools to everyone. And like almost all of that work was done February 28th.
Pretty quickly, huh?
And like in January, February that year, our biggest concern was how are we going to get people to use these tools? And then 2 weeks later, it was like, thank God we did that when we did, because we didn't do it because we were facing a pandemic. We did it because we were trying to be innovative. But because we were being innovative,
saved you
we
right
made
there.
that transition so much more smoothly than a lot of others. Well, Jeff, I know you have some slides for us. Let's get into the mechanics. How are you measuring and scoring innovation?
Yeah, I won't bore you to death in just a few slides just to talk about it. But the way we define innovation is really taking ideas and implementing output. It's from a product standpoint, from a process standpoint, from a business model standpoint, from a services standpoint. And our analysts are asking the clients as they sit and talk with them in the rating process, what's your ROI? And what's your return on some of these things? Now, some of those things can't be measurable. And I want to make it clear that when we talk about innovation, it's not purely technology, okay? It's not purely technology, and it's not. We heard a lot of great talk on AI and this process of technological advances, and I'm certainly going to touch on that. But it is not just purely that, because we have companies that we rate have $2 million in surplus, all the way up to the State Farms, Ace, the Alliance, Allianz, and Chubbs of the world, and AIG. So it is not just looking at a company who might be a single line writer in one county in one state. You've got to push technology. No, it's how do you evolve with that? So
Amen to that. And this is coming from a technology guy who is all about, the new technology and the latest thing. But innovation is also about culture. It's about leadership. It's about ESG from our
Yeah.
last panel. It's how are you looking at things differently
Absolutely.
and not just, well, that's how we've always done it.
Yeah. So I'll touch on a few things on the nuts and bolts of it, but a little disclaimer. I'm talking about innovation, and I got notes on written hand paper. I usually dictate everything down through, voice recognition to my iPad, but where I was ready to start taking some notes, I was in a pretty crowded environment, so I don't want to, aggravate people.
So, Jeff, can I tell you something about myself that
You can, absolutely.
as an innovation leader, I've always tried to lead by example. The last time I printed a document for work was June of 2013.
That's good. Good
I mean, I still have to print. I had to print out my parking pass to park here at Drake.
Yeah.
So there's some things that you still have to do. But I have not printed a single page for my personal use for work in over 10 years. I just hit that milestone.
That's great.
That was pretty cool.
Absolutely, that's awesome.
It can be done.
Yes. When I was in the office, I used to run around with a tablet, and that's all I had. So, as far as some of the things on scoring, so when I talked about balance sheet strength, operating performance, ERM, and business profile, everything that you're seeing here and talking about, we incorporate into the building block of business profile. Again, that's the most subjective, looser type of thing. So all this stuff goes into that assessment, and we disclose, the high level what the business profile, score is in our credit reports. But it's really a component of, and this is very mathematical, like similar to ERM, how we're assessing. There's an input score and an output score. I think the input score, what we're talking about, is two things you just hit on: leadership and culture. So the inputs are scored this way, where we talk to the senior management of these companies, and we say, all right, and the discussion this morning with the CRO group was great, because they talked about extending it all the way down to all lines throughout the company, and that's the culture aspect. Leadership needs to push it. We need to see it in all of the conversations at the company. Resources, and processes and structure. So we look at all of those things, and we, as analysts, as technical people, we put numbers to them. So these 4 buckets here, you're looking at it, can score a range from 1 to 4. Simple, 16 points, right? So what's the other side of it? The other side of it is the output. The output is really 2 things: results. When we think of output, level of transformation. What physical results and what's tangible results, and what level of transformation is that? Again, not necessarily a technical transformation, but a transformation of sorts. It might be technical, it might be operational in nature. This is only 2 categories, but it's double weighted. So again, 1 through 4 times it by 2, you get 16. Two parts of it.
Let me chime in, because I really appreciated this when it first came out, because as an innovation leader, I was constantly being asked for what's the ROI? What's not only the return on the investment, what's also the return on innovation? And so much of it is subjective. And so especially not only calling out that you don't get the outputs unless you do the inputs. And with the inputs, it was a way to, I guess I would say, objectify the subjective.
Yes.
Since those are very subjective measures, but you can put numbers around them, especially, in comparative. Are you doing it or not? How do you score that? So I really appreciated that.
Good. I appreciate that. Thank you. And part of the business when we talk about business profile, I said this is a component of it. Business profile is your position in the marketplace. What's your distribution channels? Do you utilize MGAs, MGUs? What's your brand in the market? So it's all the softer stuff, but we try to put numbers to this, being, geeky analysts. So
Well, and the 2 components is And I've heard other innovation leaders lament at times that they feel like they're doing innovation theater without actually getting things done. Or are you just doing innovation for innovation's sake? It's the innovation equivalent of greenwashing that we just talked about in ESG. But the point is, unless you go through some of that, you're not going to get the results on the other side. And it's a really key point because there are so many shiny objects out there in the insurtech and fintech space, so many new technologies. It's very easy to get stuck in just chasing those shiny objects, but at the end of the day, you still have to do something with it.
Yeah, absolutely, and that's part of the analytical conversation. We tend to avoid looking at the shiny objects and say, show me what you've done. Show me the output. So, this here is just a summary, and when I'm talking about, this is part of the business profile. It's part of the rating process. So when an analytical team meets with companies, meets with senior management, goes back, does their analytical work, does their assessment, a lot of back and forth with the companies. They present that to a committee. So it's almost like it is a credit rating committee made up of 6 senior people up to 11 people, and they make the decision on this as an A-. They decide on it. But this information is provided to that committee. And we've, this is our band of, from a leader, prominent, significant, moderate, minimal. And you can see where, this information is part of the rating committee. So, looking at the scores for a moderate, 12 to 17, you're only hitting 50% if you're looking at a score of 32. The significant, meaning that they're significantly an innovator, 18 to 22. So keep that in mind as to when I go to this next slide. Because this next slide shows what the actual scores are from these 3,600, 1,500 rating units that we deal with. And almost 60% is in the moderate category. So it seems a little harsh if you're looking at that. And maybe in your minds, well, we're great innovators, and I would expect to see, 50, 60% between prominent and significant. This just demonstrates that although there's a will, the insurance industry has lagged over time to see those results. And the different, pieces here, you see a little bit of an improvement, and this is from March 21 to January 23. So, not a big amount of time, but there is, improvement where we're seeing it slightly tip up. And we expect to hopefully see that from moderate to be more weighted towards significant and onto the prominent. So, that's where the actual results are and what committee is seeing.
Well, I know you're going to share some more benchmarking results here in a minute. But that's what I've been really curious to see is, can you draw a correlation between either those companies with higher, credit ratings or various sizes, who's doing the innovation, who's being innovative, and then we'll talk some more about what lessons can be learned, from that as well. But I know you have some.
Yeah, I got a couple, just 2 more here. And this is very messy, so any of the students out in there, maybe condense it down and not have so many stratifications. But this is about size. The top bar is companies with $2 billion of surplus and above, and then it goes all the way down to the lower levels. The right side, the pale blue into the green or olive green, is minimal to moderate. So you can see that we see more innovation in the larger companies because they're putting more effort to it. But like I said before, the smaller companies, they're also, making strides in.
And this probably wasn't too surprising, right? The bigger companies have also more resources. They have more vested. They have more. You're more likely to have an innovation leader, an innovation team. Maybe more likely to be investing in insurtech and some of the platforms out there. The bigger you are.
Yeah.
But I still think it's interesting that even some of these companies, at 100 million and smaller, you're still getting some clear leaders and prominent coming out of that.
Yeah, and it's like I said, they tend to be maybe not so heavy in the tech, but more in the smarts and what they're doing from an operational standpoint.
And maybe more nimble.
Yeah. So next is just stratification by rating level, and at the bottom where we show rating levels, those are issuer credit rating levels. So it's not the standard financial strength rating. It's a little more granulation scale we have, which matches to some of the other CRAs. But off to the right is the last three bars are really, B, B minus, down to C, and so forth. Obviously, a lot of minimal with the blue, and as you move up the rating scale, we see more percentage-wise. This is of companies that are more innovative. So, um, that's an indication where the rating aspect of it is. And this last slide, so I want to hit is left portion of it talks about premium growth with the you know better innovators, what we're seeing across the board. And again, this is 3,600 companies we're looking at. Higher growth rate, from a premium perspective, and then also from an expense ratio, better expense ratios for the more innovative companies. So that would, we didn't expect anything different from it when we did this study, but these are hard results.
And there you have it, innovation as a competitive advantage. But it's also got to be really, validating that you are seeing this correlation. I mean, that's
Yeah.
you don't know that whenever you start off and built the criteria. It was a hypothesis, I'm sure, that those companies that had the higher ratings were being more innovative, more likely to adapt to change, et cetera. But to see this
Yeah.
actual come through.
Very similar to the process we took.
Yeah.
So.
Well, let's then talk about kind of lessons learned and insights, and maybe even into some examples. Now you can't probably mention names, but how these companies are actually going about where is that innovation? Is it more on, you see some really getting it on the inputs versus the outputs? Are those that are in the prominent leading that both kind of, what's the makeup there?
Yeah, what's the makeup? So I categorize it really as the innovators are attacking it from a customer preference and expectation. We see a lot more in that, and just looking at this is just data that we've assembled from.
Our customers haven't changed.
Oh no, societal
I
changes.
mean, they're still doing everything by, U.S. mail, right? Like we did once upon a time, and phone, and
Yeah, wow.
just changed a little.
Just changed a little bit, right? Well, ever since you stopped printing stuff, everything changed. But I want to dispel the method that just look at it from a perspective of we thought at one point in time the independent agents go away, right? Technology is coming through; it's going to take away. It's not the case. Hasn't happened. And from a societal change on wanting real-time information and providing real-time quotes and easy things, from what we've talked to these companies about, it's really we want to dispel the method. It's just not about giving them something quick. We've actually heard a lot from a customer experience that they want interaction. Now, it may not be personal action on the phone immediately, but they want advice. So a purchaser of, and we see this in the personal lines auto, we see this particularly in the health industry, and others are joining, but if you're doing a customer experience through technology, the customers still want that piece of advice and make it very simple. And that's probably the biggest trend we've seen in some of these companies. And also a straight cut through to, let me talk to somebody too. So that's part of it. It's not just, we're going to throw technology in and hope for the best. It's that personal touch. It's that education that people still want, believe it or not.
Well, and in many ways, this technology has enabled even the smaller insurers to remain relevant and competitive. And I shouldn't just say insurers, I'd say brokers and wholesalers as well. I mean, we saw this in the banking space, right?
Yeah.
With fintech. A lot of small banks went out of business and couldn't compete because it was just the big banks who were offering the mobile apps and bill pay and, deposit a check, from your phone. But because that technology became readily available and it brought the price point down, that now every small bank has an app and has bill pay and has all those things. It's also made it more accessible. And I think the same thing is happening in the insurance space.
It is, and I think that the key to it too is that personalized experience. And I think you had mentioned yesterday in the talk about AI. And she said, and I remember her comment was, it's a personalized experience. What we're seeing from and the companies we're talking to, they want to be able to direct through the use of, social engineering, through the use of all this big data, through the use of, predictive analytics, change that person's experience, that purchase experience, to guide them so it's personalized, rather than not just, oh, I say yes or no. It's much, much, much more extensive than that. So we're seeing companies doing that and keying and focus on that personalized experience through the through the sales chain.
Yeah, but there's also no doubt how much mobile, our phones, our iPads, and everything else has changed that customer experience and journey. But I do think it's quite, fascinating that we still want that opportunity to engage. I know I still bank local. I still work with a local agent. I don't talk to them. I don't go into my bank. I probably haven't stepped foot in my bank in 4 years. I haven't actually talked to my agent in two. But we still interact on a regular basis because insurance and financial services, it's complicated stuff.
Yeah, and I think that experience, and what we're talking to carriers, the reason why they're doing that and trying to be personalized with it is retention. You have a client for longer term. I mean, it's amazing the amount of profitability you have that from a particular loss perspective, but also an expense perspective. So if you dedicate your time from innovative activities that would be able to improve the retention rate, I think that's a big key for insurance companies.
So looking beyond the customer experience, what other areas are you seeing the industry and the carriers that you evaluate? Where are they getting traction? Claims, fraud, underwriting, where else?
Yes, yes, yes. Yeah. So let's just touch on maybe we could risk mitigation efforts, right? And what we're seeing, I just want to point out, personal auto, health, and the reinsurance. Those three segments, what we've seen as being the biggest innovators to date. Not to say that others aren't doing it. They're doing it tremendously. Like on the life and annuity space, have made great strides in that interaction with the client and being able to, provide them with ease of purchase, policy issuance same day. I mean, you never had that in prior times. So, but we're seeing a lot of that. So with the health space, risk mitigation, what you're talking about there is yes, it's the use of technology, but it's the idea of looking at clients or potential clients and saying what are at high risk, whether it be from high risk pregnancies, diabetes, liver, kidney issues, directing those clients so you can retain them as long-term client to the case management aspect of things. So we're seeing that. I think another big piece beyond that would be what you had touched on is fraud, okay, and fraud mitigation. So it's not only just risk mitigation and trying to use technology advances, use operational advances to go after the fraud. We're seeing that with clients that are utilizing every single piece of data on current clients and past clients, and they're analyzing every single pinpoint of those claims to use that for predictive analytics for going forward. Are there potential fraud, the fraud involved here? And I think when we talk about AI and utilizing AI and producing...
There it is. I was going to ask about AI next.
So it's the biggest hurdle that we've seen and is going to be fraud. How do you go after and how do you decipher those pieces of fraud? And like I said, it's not technology. Let me just give you an example of one company that this is so untechnology related, but I was at a client and they were a homeowner. Well, they are a homeowners writer, focusing down on the Gulf Coast, Texas to Florida, very heavily involved in Florida. And we were down there visiting for our annual rating meeting. And when we have annual rating meetings, there's one annual rating meeting, but in some clients, I'm on, when I was in analyst, I was on a call with them every other week for something going on or something talking through. But this company, we're there visiting, and they were like, oh, we want to give you a tour of our office. I'm like, I can stand up and pretty much see everything, right? But I said, oh, sure, that sounds great. Looked like any other office. And then we started walking down aisles, and it was, cubicles, right? This is when everybody's back in the office, cubicles.
No, really?
Yeah, there was
Cubicles in
cubicles.
an
They still have
insurance
them.
company?
You got it.
Not as much as it used to be.
Yeah, crazy. Huh? So the way he pointed out was, he's like, look at this bank of cubicles. And I think there's 5 or 6 cubicles here, 5 or 6, and it was a U-shaped. And in the middle of the U-shape was an empty table, long empty table. And he goes, that's what we do. And we intermingle our claims folks with our underwriting people. And those tables, they literally, when they were in the office, spun around and talked to each other. They improved their loss ratio by 5.5% over an 18-month period. And their expense ratio went down because they were constantly talking to each other. And that's what I'm saying. Nothing technical, right? But just that innovative thinking, and that comes from leadership. And he was so proud. This company was bought out by an auto writer, a major auto writer that you would absolutely know who they were, and they are just thrilled to have this homeowners company partner with them. So just a little bit of a tidbit on that.
Well, and that's why when I think back through some of my experiences too, some of this is also driven by, let's face it, some FOMO, some fear of missing out. Kind of getting back to the chasing objects. How do you think those innovative companies are also prioritizing, since there are so many things to think of? And is that leadership? Is that evaluation?
Yeah,
How are they
I
getting
think
to that?
it's really all of it. They're prioritizing based upon what they think they can get a bang for their buck right now. A lot of the prioritization, customer, facing, is with what I mentioned, the customer experience, and how do you handle the client more and their expectations, because their expectations are going through the roof, right? I think the big thing they're doing is internal operations and making efficiencies there. So they think that they definitely can have innovative things on how to change operations. So they're going after those things rather than they're dabbling in AI, and I don't think AI, from what we've seen, is clearly down the road that most hope at this point. But
Well, in the venture space, if you name your company, XYZ AI, it's suddenly worth 10 times more than it was the day before. It's the buzz. How are your analysts really kind of digging into what's real, what's Memorex, what's real, what's fluff in evaluating and using AI, or at least the generative AI large language models that have come out since ChatGPT 3, right about a year ago?
Yeah, well, they want to. The conversations are what are you going and using it for? And like I said, it's the customer experience that they're utilizing AI for. On the health side, it's utilization of medical records. Doctors can't write for a bean, and they still have paper. They're utilizing that heavily to just process tons of documentation and extract summary information from it, to be able to utilize it to talk about, to do those things from a preventive and risk management, identify clients and patients that through medical records, through pharmacy use, through who might be a risk down the road. So they're using it from a risk mitigation perspective. And that's why I say the health industry is a little bit further along. The analysts are also asking from a claims perspective, specifically, what are you doing and what are you using it for? So,
Jeff, I just have 2 more questions before we open it up to audience. So be thinking about anything that you'd like to ask Jeff. We haven't talked about MGAs yet, and it's something that we talked briefly about in prepping for this session. How that as a distribution channel is playing into factors around innovation. What are you seeing in that space?
the use of MGU is just continuing to take off. Now, when you talk about fintech and insurtech, you've got a lot of companies that may not necessarily know the insurance space and how to work within the parameters of all the regulatory things, but you do have a lot of MGAs and MGUs utilizing technology that don't have the legacy, platform issues. It has been a great source because they're more nimble than the carriers. They have a lot of They have a lot of talent that they stole from the carriers over the past 3 to 5 years, and they specialize in certain segments of business where they have the specialty that they can underwrite better than some of the carriers do. So that's the use of the MGA space.
Yeah, and so you think those carriers who are partnering with startups by providing that underwriting capacity or building programs around that is viewed as more innovative then?
I
Or does it?
It depends on the book of business if the MGA is bringing to them. And we look at it, we do it, on the analytical side. We'll look at that book of business that the MGA has and the profitability. Sometimes I've been in committee where they said, I want to see 15-year loss run on an MGA that this carrier is going. Now, those are the more established companies, but obviously for the MGAs that are just up and running, we'll do deep dives into what benefits they can provide to the carrier.
Oh, makes sense. I mean, that business is on their books, so.
Yeah. And one other point about, you mentioned, well, what are some of the things that we see companies doing well from an innovative perspective? And I think the biggest thing that we're seeing, well, not the biggest, one of the major things is embedded insurance. The use of embedded insurance. Embedded insurance is point of sale, quick point of sale for clients. And we see it globally too. Believe it or not, it's very much particularly on some of the life products and health products internationally, where there is a ton of embedded insurance throughout different traditional mechanisms, meaning a client's going to a bank, that's where they're purchasing it. And quite frankly, some of our ratings that we're trying to make headways into the global industry is tough because they not perceived as a needed thing because it's all the focus is on the distribution channel of the banking industry. So embedded insurance is there, but in the States, embedded insurance is becoming more and more prevalent. Again, that's probably really the use of technology more so than anything. But I think there was a Deloitte study within 5 years, well, within 6 years, by 2030, there's going to be $70 billion in the U.S. of embedded insurance. Internationally, times that by 10, $700 billion. And you have someone like, Travelers who started out at $0 embedded insurance. Now they're above, in an 18-month period, they bought that embedded insurance north of $1 billion. So that's a big opportunity for carriers.
That's a great point, and for anyone in this space to be looking at those bigger trends, and certainly in the insurtech space that I live, we're hearing all the buzzwords, every day from not just generative AI and parametric insurance and embedded insurance, but even within the embedded, there's so many different layers to it.
Oh yeah, absolutely.
Some are the point of sale, like the travel insurance you buy when you buy a plane ticket,
Yeah.
and some are. Many of us have always wondered why the big auto carriers haven't found a way to crack that nut of selling the insurance at the time you buy a car. Well, they're really making some inroads.
Yeah, there is a lot of inroads to that. I mean, that's a absolute big. Tesla's looking. You've got some of these companies who are doing it, and yeah, that's.
And then even embedding insurance products to the point where it's just an included product. So someone shared an example recently of a skateboard helmet that automatically came with, $10,000 of accident insurance. It wasn't an option. It wasn't an add-on. They believed in their product, so they were just completely embedding a $10,000 policy.
Absolutely.
And so that's why I don't think InsurTech is slowing down anytime soon because.
No, I don't think so. I think they've kind of learned the lesson from a perspective of taking risk on, and directing the their efforts towards providing what they can provide from a technology standpoint. I mean, if you look at the capital, the capital plane, the investment. I mean, you're in this space, but what we're seeing too is still an uptick on investments in the embedded space as being something for the fintech insurance tech. If you're in embedded insurance, you got a better look at capital raise.
I was just having this talk a couple weeks ago. Any Ted Lasso fans?
Oh my gosh,
love
yes.
Ted Lasso, and we just rewatched it. And the other day, Danny Rojas came onto the scene. Danny Rojas is the soccer player that comes around screaming, "Football is life! Football is life!" And it kind of hit me that life is risk. Life is risk. Everything that we do has risk as individuals in
Everything.
business and in commerce. But what an innovative approach, leveraging technologies, is anytime there is risk, if you can measure it, you can try to mitigate against it or you can build a hedge against it. And we are now able to measure risk and predict risks in ways that we were never able to before because of technology, because of sensors, because of artificial intelligence. And those insurers who are leaning into it are certainly making a difference. So my last question for you, Jeff, is let's look forward. So you've seen some really interesting and compelling results so far. What do you think is next? And it's a two-part question. So broadly, sorry, Siri, I really wasn't asking you a question. Boy, that was just like on cue, wasn't it? Thanks, Siri.
Next question.
I really don't have an answer for that.
That wasn't me.
Oh, that was perfect. So where do you see these trends going? And then coming back full circle to my first question around 10 years ago when AM Best added the ERM, Enterprise Risk Management, to the scoring. Today, the innovation score, as I understand it, is kind of separate. It's maybe included, in the conversation, but it's not the math. It's not part of the math directly. Do you see that changing?
I'll hit the, well, so as far as where we see it, let me just go in order, unless my watch goes off. Where we see it going is really akin to if you ask somebody in the 60s and the early 70s, whether it be the insurance industry or any industry, what do you think about these upcoming PCs? Personal computers. What's going to happen? Oh my God, I'm out of a job, right? Not the case. Increased productivity. It changed people's jobs. And that's what we see happen in the insurance industry. It was talked about yesterday on the AI panel. I think there's a long way to go from insurance really accepting it. The insurance industry has been traditionally a lag on technology, and that's why some of these things, from an operational standpoint, non-technological, looking at things and how can I do things better, are still going to be paramount. But it's just going to change the way you do things. So less crunching the numbers, less looking at trying to decipher 150 pages of regulation or something, whatever it is, and focus on analyzing things more. Focus on developing products better. So I think it's just a shift. It's not going to be, oh my God, I'm going to be out of a job, and the college students are here. You're going to have more of an opportunity to make things. So that's where we see it going. As far as disclosing the innovation scores, they are disclosed to the clients.
But not to each other.
Not to each other, no. At this point, it's whatever your score was by each individual segment. We present it after a rating committee determination. Analyst is on the phone, communicated with the client right away. We do it in writing through an email through our systems, and within 3 days, the rating is out the door. That communication to them has innovation scores in there. I don't think, at least at this time, and actually, I just touched base with our CREATIA folks about an hour ago to say, any further chatter on us publishing these innovation scores in the credit reports or publicly. I don't think that's going to happen right now because, quite frankly, we don't want to take this whole analytical process and say, well, are you an innovator or not? And it's going to take your rating from an A to a B or up and down. So I think we need to have more data before we come out with that and have this process mature a little before we do that. But we are going to publish, in the aggregate, some of the statistics you saw there.
Well, I think it's really fascinating. And here again, kudos, Jeff, to you and all of AM Best for the progress in this space. We have a couple of minutes. Anyone from the audience have a question for Jeff, myself, around insurance innovation, criteria, scoring, and impact? Look at it. We've got a couple just for folks watching online that we're getting to in the room. Microphones are being delivered.
Great. Thank you for the conversation today. Very informative.
A few years ago, as this space emerged, the regulatory environment sometimes wasn't always agreeing. If we think about insurance traditionally in many of the jurisdictions that we operate in, what's the climate look like today? Is it interfering or permissive?
Specifically from innovation, what clients are doing, or just in general, the regulatory environment? I just want to make sure I answer your question, and it's be
Sure.
both to Jason and I, we can answer.
Yeah, I mean, in regards to just some of the things we talk about or think about implementing can be very innovative, maybe push
Okay.
boundaries, if you will,
Yeah.
from a law that may have been on the books for 50, 60 years, those types of things, just the way that we do things.
Yeah, I think that it depends, if you're talking internationally versus stateside, and even stateside, you've got, regulatory bodies. And I think you probably know which ones those are and what states they are. We have a harder time with things. I think as historically over the past 5, 10, 15 years, the use of credit scoring, insurance scoring in the auto market has been challenged significantly. Um, and I think that we start coming out with a lot of even more technologically advanced products based on different characteristics. I think there's always going to be challenge based on regulators, but I think that from my perspective, what I'm seeing, the insurance market has done a very good job of explaining and proceeding on. So I don't see any major barriers with it. I think they're going to be skeptical on pure use of AI and what you're doing with it, and it's going to take a lot of time to explain. But ultimately, I think that hopefully they'll be able to work with the regulators.
And I'll share, just from a personal note, to give credit where credit's due. I think some of us take Iowa for granted. I know I did, especially early in my career. We've had some great regulators and a great climate, but that's also because of the ecosystem here, including Drake University, including the Global Insurance Symposium. We've been having these conversations for a long time, and it wasn't until I started doing some work and products in other states that I realized, oh wow, it's a different landscape. That said, I think across the board, the entire industry and the regulatory has been moving forward. There's so many more conversations around, not just things like artificial intelligence and rating inputs and everything else. Is everyone there yet? No, but I think more and more people are on that journey together than we were just a few years ago.
And me as an analyst, when I was rating companies, I had a lot of clients in Iowa too, and it was an absolute great environment. Getting everything you want, but dealing with that compared to California or to New York or to others. I mean, the running joke on meeting with some of these CEOs in California, we go in for a 4% rate increase, we walk out the door in a 10% rate decrease. Now, I'm not saying that's anecdotal from them, but it's just the mindset of some of the things. And certainly California has made great strides in a lot of the things they're doing, as well as Florida. But yeah, different regulatory, different challenges.
Yeah. Thanks for the question. I think we maybe had one more question in the audience. Anyone else?
Just let me make one more comment if
Yeah,
there's
Jeff, go
no
ahead.
questions about, we talk about a lot about what I said, the client face and the using innovation on the client facing things, but I mentioned also operationally, and doing things operationally is a big piece of it, and I think it's a huge piece of it. And the panel earlier that talked about, the CRO panel that talked about, stress testing and what you do from a risk management perspective and a stress testing perspective. I think from an operational perspective, we see a lot of innovative things on companies doing, stress tests, and whether it's from an investment perspective, whether it's from a catastrophe perspective, and for companies to keep doing that, we're seeing definitive and quantitative improvements in their performance and their operating performance over time for those companies that continually do that on a good basis. And I'll just end with a couple of stats and maybe make some closing. But as far as impairments on the USPC side, catastrophes over a 20-year period, from a study from 2020 to 2022, and this leads directly into companies doing a good job or a bad job of stress testing and making sure that the risk management processes are in place, which, like I said, we feel is an innovative thing. On the PC side, 30% of the companies impaired based upon catastrophes. 25%, and I'll make a correlation to the life, health, and annuity space. And really, obviously, there's no catastrophes from a natural catastrophe perspective, but 30% of the impairments were due to ACA. Both on the PC and US side, 25% impairments over that almost 25-year period were due to fraud. Whether it's internal fraud, we saw internal fraud and issues with regulatories, or fraud impacting the performance of the companies. And then issues with affiliates is 20% on the PC side, 15 on the life side. There are a lot of affiliates out there that insurance carriers and private carriers, they have non-risk-bearing entities. They have some pretty funky companies that they own. And then I'd say just end it with rapid growth being 15% across the board between two industries. And then obviously on the investment side, about 15% of impairments due to investments for the life and annuity piece of things. But you can fix that through constant stress tests and innovative things that CROs like Scott and others are doing on a day-to-day basis. And it's not necessarily technology-driven, client-facing, it's internal operations.
Well, Jeff, what a great way to wrap up this forum. I mean, it is the Risk and Opportunity Forum. We learned a lot about risk, and I think we also learned about what opportunities are out there as well. So on behalf of our audience in person online, Jeff Mango, thank you very much for being with us today.
Appreciate it. Thank you.
Thank you, and that is a wrap for the entire conference. Over the last 2 days, I would like to thank our panelists and those who have helped put this on with our steering group, our sponsors, Drake University, and the College of Business here, the Zimpelman College of Business at Drake. Thank you for attending both in person and at a distance, and we'll see you next year. Thank you.